Welcome to Financial Freedom Program. My name is Samir Bapat, and today we are going to learn about future and options. So it's an introduction to future and options. I'm not sharing any technique, but it's a very important concept in stock market. So today I'll take you through the important concepts of future and options. Today I'll take futures, and maybe in next two webinars I'll take you through the options, basics of options. In this, some introduction to options I'll take you through. It's a very interesting field in stock market, very powerful, and it opens venue for people to earn lots of money. So today we are going to learn what is futures, what is derivatives, what is futures trading, terminologies used in futures trading. So I will be creating a solid foundation for you all today in futures trading. How many of you know about futures trading? Future and options, type yes. You already have been trading or you are aware about this. Okay, so if you have never heard about what is future and option, you have heard, but you absolutely don't know about future and options, type no. If you don't know anything about future and options, type no, so that at least we know how many people are there who are attending for the first time. Okay, so you don't know anything about future and options. Great. So I have lots of people who are going to understand about futures for the first time. Great. Welcome all. So I'm addressing the right people. Let's begin. Now, this is a little highly leveraged instrument. So here is my disclaimer that, okay, don't blame me if you don't go by a system. Okay, so this is a disclaimer I have to put out. You can read it, or in short, okay, take care. Don't just jump by learning today. In short, this is the warning I want to put you. People make lakhs of money trading in derivatives. That is truth. But it is also true that people trading without any system, without any proper training, without any proper money management or risk management, have lost lots of lakhs of rupees. I know personally many people who have lost to the tune of 1 crore trading in this, and there are people like you and me. They are just like us, but still they kept on trading without any system, and they lost to a tune of 1 crore, and then they realized no, they should have gone with a system. So that is how the system is there. So this is the warning. So, and do not trade without proper trading, without proper system and proper guidance. That is my suggestion. Once you understand about future and options, future and options is really highly leveraged instrument, and you should be trading it carefully. If everyone understands what I'm saying, and you acknowledge that you will be doing what I'm suggesting here, type yes. Okay, great. Thank you so much for acknowledging that it's a really risky instrument. We have to be cautious. Now, advantage of future. How many of you have know that in shares you can buy first, and let's say if you buy a share for 100 rupees and you sell it for 110 rupees, you will make a profit. Everyone agrees? Can I have yes if you agree with this point? That in share, if you buy at 100 rupees, you sell at 110 rupees, you'll make a profit. So the way you calculate your profit is sell price minus buy price equal to profit. In case your selling price is lower, if you're buying at 100 rupees and if you're selling at 90 rupees, you will have loss. Everyone agrees this is the formula how you calculate the profit. Sell price minus buy price equal to either it can be profit or it can be loss. This is possible in shares only. So shares we buy first, We hold it. When it goes up, we sell, we make profit. This is how we make profit in shares. In futures, in addition to this, in futures, when we are doing futures trading, which I'll take you through, in futures trading, we buy first. When the price goes up, we sell it. That's how we make profit. But in future, we can sell first at a higher price. I can sell something at 150 rupees first. Then, when the price falls, I can buy at a lower price and earn money. This is the advantage of futures. Let me quickly take you through a example so that it makes some sense. Let's say if this is a stock of Apollo Hospital, and now if you are trading in Apollo Hospital, if you are trading in Apollo Hospital, normally how do you earn is you will buy somewhere here, you will buy at, let's say, 3714, and hold it for few months, and July, August, September, October, you will hold it till here and you will sell it. So you will be able to make money in stocks. Agreed? How many of you agree that if you buy here the share and you hold it till here, you will make money? Agreed? You will earn money. Correct? Yes, no? Now, is it in shares? Is it possible that you sell here first? So 5760 you sell. You don't have the share, but you are selling the share first. Hold it and buy it again when it reaches 3808 and make money. So you are making money starting from here to there. You make 2000 per rupees per share. When it is coming down from here to here, again you make 2000 rupees per share. So share is going from here to here, here to here. You are able to make money two times for the same move, going up, coming down. Is it possible to do in the shares, to sell at this top and buy when it is coming here? Yes, no? Yes or no? If yes, type yes. If no, type no. Yes, sir. Nikhil, my question, listen to my question. If you can, how many of you can sell on 26th November at, let's say, 5,000, 6,000 rupees, and hold it for 2 3 months and sell it after 2 3 months at 370 and earn 2,000 rupees per share? Nikhil, what do you think? Can you earn like this in shares? Yes, no, no, no. Fine. So share is limited for us to earn from when the markets are going up. Futures gives us an option of earning money when the markets are going down. That is the advantage of futures. So we are going to learn some terminologies about the futures trading, which will enable you, as you learn more, it will enable you to earn from a falling market as well. How many of you are ready to learn that? Can I have yes from all the people who are ready to learn how to earn when the markets are falling down? Okay, yes. Okay, great. So today we are going to understand what is the basic concept. How do you sell first and buy later? I'll just go through the concept. I'm not taking you through the technique. Now, we have understood that in futures it is likely to sell first and buy later. Now, before I teach the concept of selling first and buying later, the many people find it very very difficult as you learn futures, and many people find difficult trading in futures, in options, and it takes some time for them to grasp the concept. If you are finding difficult to grasp that concept, believe me, it is not you, it is how our mind has been tuned since childhood. Since childhood, do you agree that in our question paper every time it will come, Ram bought something for 100 rupees, he sold to Sham for 150 rupees, tell us how much money did he make? Or X bought from this much for this much, sold at this much, tell us what was the percentage profit he had or percentage loss he had. So from childhood till almost our graduation, every time, all our questions in our question paper or in our textbook, every time they taught us falana falana bought at this price and he sold at that price, tell us what was the profit and loss. Do you agree? To every all question papers only taught us to buy first and sell later. Agreed? That is how we are tuned for till 18, 20, 24 years of old, when till we are 24 years of age, our graduation, everywhere we are having this question only. Yes, no? Correct. So we are having these questions only. So our, why I'm saying stressing so much is many times people find it difficult to, they understand the conceptually but difficult to implement, and then they do mistakes. So first of all, if you are doing mistakes in this, believe me, it is not, it is because not because of you, because the way we have been handling things or seeing the things. Second thing is, we whenever see the business around us, we understand, okay, how Domino's pizza makes profit. He buys the raw material, makes into pizza, sell it to us, makes some profit out of it. So again, in our concept for the business around us, we see people buying first, selling later, and making money or earning money. And that's how our brain has got tuned, and that is how we accept it. So for us to accept that we can sell something first and buy later, it becomes little challenging to accept and acknowledge. Why I'm stressing this point is, as I will go through the concepts, you will have to use some of your imagination, artist part of yours. You have to be more artist and logical together. You will have to think, visualize with me as I explain, and try to grasp the concept of selling first and buying later, that it is possible to sell first and buy later. And this has been happening for last thousands of years. People have been selling first and buying later. We are not exposed to it, so we are not aware of it. So far so good. Yes, okay, great. Now just to explain you the concept of futures and futures. Right now options will cover in the coming weeks, coming 2 weeks I'll explain about options, what is the options world. Just for our storytelling thing, let's understand a scenario that what there is one Mr. A, and Mr. A owns a cloth mill. He's a manufacturer of cloth. He manufactures cloth in lots, multiple lots he will manufacture. So huge lots are there. So today, the date is 21st of June. We all know that. And his one lot of cloth will be ready by 30th June. I want you to think, imagine, or feel the first sentence. Can I have yes if you're okay with me saying there's a Mr. A, he's a manufacturer of cloth, and all this blah 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 blah. Then there is a Mr. B. He is a bulk purchaser of cloth. He buys in lots. He buys the cloth in lot. So he's in the we everywhere we have bulk purchases, right? The people buy in bulk and then sell it to retail. So Mr. B is a bulk purchaser of cloth, and he buys in the lots only. He does not buy in 1 meter, half meter, something. He buys in the lots only. So A is a person who sells the cloth in huge lots, and B is the buyer who buys in lots. So far, so good. So everyone is there with me, imagining this scenario. You are with me, you are imagining this scenario. Yes, feeling this scenario, thinking about this scenario. Okay. Now, current market price, as we know, the whatever is the current market price, this is the terminology we'll understand. Now, let's go to this example on a Excel sheet. Okay, now since we are a lot of people, I'm restricting you to chat, but if you have any questions, you can ask in between. I'll pause for a minute because this is a little interesting subject, so I'll pause for it. Just type your question. So as I had mentioned, A is a manufacturer. You can see the screen, right? The Google Sheet. Everyone can see the Google Sheet. On the screen, I have shared the Google Sheet. Yes, okay. Now, let's say A is the manufacturer and B is the bulk purchaser. So he purchases in bulk. Now, let's replay the scenario. Lot size is one lot cloth. Like I said, today's date is 21st June. The manufacturer's cloth will be ready by 30th of June. He will be able to bring the cloth, one lot of cloth on 30th June. Okay, only, not before that. He will be bringing his one lot of cloth on 30th June to the market to sell it. Now, so his factory is working, the people are working, he is free. He went to the bulk wherever the sale purchase happens for the bulk cloth. He went there, and since the Mr. B was his friend, so he asked him, Mr. B, what is the current market price of one lot of cloth? So he said, it is mentioned here in the cloth market, it is displayed, the cloth you are bringing, the current market price, what I have mentioned here is 8 lakh rupees. Okay, so the today, as of 21st of June, B tells A that the one lot of cloth is worth 8 lakh rupees. I'm just making up the story, okay, to explain the concept of future and options. So today's price is 8 lakh rupees. Now on 30th June, A will bring the cloth. So when he brings, he will bring and sell in the market. But A's view is that on 30th June, when he brings the cloth, the rate would have gone down because he is also there in market. So he has his own technical analysis or some analysis he has. So he thinks that when he will bring his cloth in the market, the rates will go down. So this is his view, this is his analysis. So his view is that by the time he brings his cloth, the price will go to down to 7 lakh. But view of B is that by 30th of June, the rate of cloth will go up. Normally, in a market also, the seller thinks the price will go down and the buyer thinks the price will go up. That's why the deal happens. So here also, the view of A is that it will go down to 7 lakh rupees. It's a view, and view of B is uh, it will go up. So everyone, so far so good. Everyone clear about the story? Yes, no? Clear? Now, are they having the view for today or are they having the view for future? you can type today. If you are think it is that view for today, if they are having the view for future, you can type the view for F for future. Are they having view for today or are they having view for future? So they are having the view for future. Okay, he thinks that, okay, so now what A is thinking, that if I bring the cloth in future, then the rate might go down, I might get lesser price. B is thinking after few days it will become costly. So what they do is, A suggests B, why don't we enter into a contract where we sign a contract with each other that when, okay, so they have a view. So A suggests B that why don't we sign a contract that when on expiry on 30th of June, when I will bring my one lot of cloth, I will give you my cloth, you give me 8 lakh rupees. We let's sign on a paper. So a contract is signed. Everyone okay? So far so good? Yes? No? Yes, no? Okay. Now they sign a contract. So they only sign a contract that we will exchange the cloth at 8 lakh rupees. So can we say that by signing a contract, A has sold his cloth, one lot cloth, at 8 lakh rupees? Can we say that he has sold his one lot cloth at 8 lakh rupees? And B has purchased that one lot of cloth for 8 lakh rupees, but transaction has not happened. Now the transaction will happen on 30th of June only. Right now they have entered into a contract. So they have entered only on contract. They have not exchanged the commodity. They have only entered the contract for exchange in sometime in futures. Sometime in future, which is 30th June. This is the this is what is called futures trading, where a supplier and a merchant, a supplier and a buyer agree on a contract to exchange a commodity on a future date, and they agree today. They agree on a price today that, okay, in future we will exchange that commodity at a certain price. So since the exchange will happen in future, hence it is called futures. Now everyone clear why it is called futures? In future and options, why it is called futures? Clear? Second thing is, can that future trading happen if the one lot of cloth was not available? If there is no one lot of cloth, can that futures trading happen? Yes. Okay. No, it will not happen, right? If cloth is not there, what they will assign, put on agreement, what they will deliver, right? What they will sign, I will deliver what? One lot of cloth, correct? So they have to have that one lot of cloth. So that one lot of cloth is called underlying. Underlying means whatever was there for which the contract was signed for the future. The execution date is expiry 30th June. Now typically, just to bring context to the stock market, when the futures contract are traded, the now who will take care that everyone is executing the contract? So the stock market takes care that everyone is executing the contract properly. So they say don't sign a contract for every day. यार ऐसा नहीं होगी, you sign for 23rd 25th. Sign the contract for the last Thursday of the month only. So if your cloth is ready on the Wednesday, last Wednesday of the month, bring it on last Thursday only. Everyone has to execute their trades on last Thursday of the month only. That is why it is called the expiry. Now, what happens is, underlying, I said it is one lot of cloth. If there was no one lot of cloth, they would have not traded. Position with reference to contract: A sold his one lot of cloth first. He has not delivered, but he sold it first. B bought it in the contract. Now, this contract, who will take care that what happens if A or B runs away? Someone has to guarantee, right? Someone has to guarantee that this contract will be executed on 30th of June. So the stock exchange will say, okay, both parties, we are the guarantor that the contract will get executed. But in case you run away, then we need some margin money, some caution money to be kept with us, so that in case you run away, we will take that margin money and give it to other party in case the need arises. So the exchange keeps some margin money. So deal for 30th June was worth 8 lakh rupees. To make sure that they have to keep some, they are signing the contract, that is okay, but a caution money or margin money is kept by the market, stock market, so that if one of them runs away, if one of them says no, I am not entering into deal, that money can be paid to other based on whatever is plus minus. Okay, so this is how the trading is done. So I'll repeat: A wanted to sell cloth on 30th of June. So his guess was it will go down. He wanted to enter into a contract so that his price is locked. B thought it will go up. So he wanted to buy today, buy the cotton in future at today's price. So they both entered. When they do have different view, they will enter into contract. They signed a contract, they have not exchanged. A has sold the cloth right now, B has purchased the cloth right now. The exchange will happen on futures. Uh, now, A is in sell position and B is in buy position. Market has taken a margin money from both. In case someone runs out, market will ensure that other will is not getting any challenges in that. So far, so good. Rahul, let's not go into accrual accounting or deferral accounting. It's not relevant in this state, in this future study. Okay, so okay, any questions? Anyone has any questions so far? So I will go ahead. If no questions, any other questions? Type your question. I'll wait for 2 minutes. So far, so good. Okay. Any questions? Anything? Okay, no question. Now, let's say one more. There is one more manufacturer. So we go fast forward. We go into future. Now let's say there is one more manufacturer which is C. One more manufacturer is Mr. C. Now he comes into market on, he also comes to the market. He can come to market. His cloth is also going to get manufactured on 30th of June. He comes to market on, when he's coming, okay. So now we are going little fast forward. Let's assume, let's visualize, let's feel that today's date, earlier date was 21st June. Now the date is 25th June. C is a manufacturer. He will manufacture the cloth, and his cloth will get ready by 30th June. But on 25th, the market price, the current market price went down to 7 lakh rupees. Just to recollect, on 21st June, when our first deal happened between A and B, date was 21st June, the cloth was being traded for 8 lakh rupees. Now the current market price is 7 lakh rupees. So it has gone down. Now on 25th of June, C and A meet. They say hi, hello. They know each other. And C will ask, okay, what is the current market price going on? So A will say, right now it is going on 7 lakh rupees. Now of C, view of C is, as per his analysis, that the price will go down further down from here. Just hold on. Give me 1 minute. Huh? Okay, so what happens is on 25th of June, there comes another manufacturer. His cloth is going to get ready on 31st of, sorry, 30th of June. He asks A from our earlier story from here. This fellow is also moving around in the market because he has his own people working for in his factory. So C asks A, what is the current market price going on for the one lot of cloth? He says 7 lakh rupees. It is written here. Now, so C has a view that it will go down further. By the time he brings his one lot of cloth on 30th of June, the price will go down further. However, A from our previous example thinks that okay, it has gone down fast in 3-4 days itself, it has gone down. Now there is a likelihood that the price may go up. So he has a view from 25th of June, the price is likely to go up and it might go up to 9 lakh rupees. So now in 4-5 days, his view has changed. Can A's view change in 4 to 5 days? Is it possible that his technical view can change, right? He earlier thought it will come down, now he thinks it will go up. So what he does is, C says, no, I want to sell it at 7 lakh rupees. So A says, okay, I'll buy it from you at 7 lakh rupees. So let's enter into contract. You do one thing, on 31st, you bring your cloth, bring and give it to me. I will pay you 7 lakh rupees and you give me the cloth. So they enter into contract. Now A has bought the cloth, correct? On 21st of June, A sold one lot of cloth. Now his view has changed. He has bought one lot of cloth on 25th of June. Now, okay, now he has sold, A has sold, A has bought one lot of cloth. They have entered into contract again to be executed in the future. Underlying is one lot of cloth. Margin money they will keep, would like the stock exchange will keep 2.5 lakhs as a margin money, so that to ensure that the deal goes through. So on 30th June, can we say that A will stand outside the market? When C brings the cloth, he will pay him 7 lakh rupees and then go inside the market and deliver to B and collect 8 lakh rupees from him as per the contract on 30th June. Everyone okay? Correct. 8 lakh rupees he said he'll get from B, and he gave it, took 7.5 lakh rupees. So he first took delivery from C and gave it to B. Everyone okay? Yes, no? How about others? Is it clear? The story is clear? Yes, no, everyone. We are 70 people, 70 plus people in the call. So at least few more yes before we go ahead. Okay. Okay, great. Thank you. So now can you see that A first sold one lot of cloth for 8 lakh rupees. Then subsequently, he bought it from some other person at 7 lakh rupees. So he sold by having a view. What if he's not having any manufacturing facility? He was not having any cloth manufacturing facility. Now imagine A was not even having any manufacturing facility. He was not having to have any cloth manufactured. He only had a view. So by having a view, he first sold the cloth at 8 lakh rupees. He had a view that it will go down. First, he made a deal for future and he sold one lot of cloth for 8 lakh rupees. After a few days, when the price went down, he entered into another contract with C into 7 lakh rupees. So he sold at 8 lakh rupees, then he bought at 7 lakh rupees. On expiry, he made 1 lakh rupees profit by having a view for going down. Correct? Agreed? Everyone okay? Everyone clear? Yes? Okay. So this is what is futures contract. So now the important point what we have to understand in futures contract. Same thing happens in Apollo Hospital, for example. If you have a view in Apollo Hospital, you can sell it here. You can sell a futures here. When it goes down, before the expiry, because before the expiry you can buy it again and earn from the difference of the two. You sell here, buy here, or either way you can buy here, sell here. Buying and selling we all know. Since this is a new concept, I try to explain it from the seller's point of view, that you can sell first and buy later in future. So you can sell it here at 6,000. You think the market is going to go down, you sell here, you buy here, you make money. So far so good. Okay, now there is something which we have to understand here, the terms of futures trading. First term is lot size. Now lot size, if I take you to let me take you to the NSE website. Okay, let me say Apollo Hospital. Okay, then since futures derives its value from the underlying, hence it is called future derivatives. We have to click on the derivatives now. Stock futures. And let me take one. Okay. Now here you can see the something called market lot 125. Can everyone see here what is written market lot? Yes, no? Okay. So if you are trading in futures, first of all, you cannot trade one share, two share, three share, five shares. It's a wholesale market. So you have to trade in lots. In Apollo Hospital, if you're trading in futures, you have to buy minimum 125 shares or sell 125 shares. So that's why it's in lots. It's a wholesale market. Futures trading is a wholesale market. So you cannot say, okay, I want to sell two shares, three shares, five shares. You have to sell minimum 125 shares of Apollo Hospital. The same will change for other different what we can say stocks, like we have Bandhan Bank. Let's say if you want to do futures trading in Bandhan Bank and in derivatives and futures, okay, and we have, so Bandhan Bank minimum size you can do is 1,800 only you can trade. You cannot trade one or two Bandhan Bank. This is called market lot. So when you are trading in futures, you should know what is the minimum quantity that you can trade. So if Bandhan Bank is trading at 297 rupees right now, the close price is 281.95, let's say 290 or 300. 300 into 1800, how much it will be? 300 into 2000 will be somewhere around 6 lakhs. So roughly the trade values will exceed around 5 lakh rupees or so. When you are trading in the futures, the minimum trade value is somewhere around 6 lakhs to 10 lakh rupees, depending on the lot size and all. It will be 6 lakh to 10 lakhs. So lot size is clear to everyone. There are all 4,000 shares are not traded in futures. Out of 4,000 shares, some 200 shares are only allowed to be traded in futures, where you can sell first, buy later. Uh, for each share, they have decided how many minimum number of shares you can trade. That minimum share number of shares is called lot size. Okay, so far so good. Then there is something called current market price. Current market price is price as of today. Then deal value strike prices at which you sell or buy the futures contract. So you enter into contract, a futures contract, which will be executed on last Thursday of the month, which is the expiry date 30th June. Like we can see here, if we see, this is 30th is the last Thursday of the month. So all the futures contract for shares will be executed on 30th. So all contract will have expiry date as 30th. So all exchange of shares and money will happen on 30th June. For July, if you see, the last Thursday of month is on 28th. So all the July contracts will have date of 28th July. In August, the last Thursday of the month is 25th of August. So all August contracts will have a date of 25th of August. So whatever is the last date of last Thursday of the month, that will be the expiry date or the contract execution of day, where the shares and money has to be exchanged. You can as well come out anytime in between also, it is possible. And if you are a new trader, you should not wait for the expiry day. You should come out of the contract before that, because there are a lot of things, complicated things involved in that. I'll take some time later what are the things. But now, is it clear how the expiry date is decided? In case it is a holiday, it will be one day before. So if 25th is a holiday, then expiry will be on Wednesday. If Wednesday is holiday, expiry will be on 23rd. Likewise, I have not seen it shifting till Monday. Maximum it goes to Wednesday. That's it. After this, what we have learned is underlying we have understood, and then we have margin money. Margin money is the money which has to be deposited with the broker, so that he will allow us to trade. So 8 lakh worth trade, you are allowed with a 2.5 lakh margin. It changes from stock to stock, it changes roughly anywhere between 1.75 lakhs to 3.25 lakhs money you need to trade for a 10 lakh worth contract. So that is called the margin money, which has to be kept with the trading platform. What else we have missed? Nothing. Okay. So these are all the components of futures trading. I would recommend to go to NSE website, click on derivatives, and have a look at all these things in futures contract, and read some more about futures contract and trading. In this, it is very, very important that you understand the technical analysis. You have to make a view, you have to make a judgment in when trading in future, and your judgment has to be right for earning the money. Everyone good? So far so good. How many of you Enjoyed attending webinar today? You learned something new? Yes? Okay, great. Happy to know that you learned something new. So this is introduction. We will take 2 to 3 more sessions in coming Tuesdays. We'll take one session. We'll develop our understanding on this. Go in some more details. I'll take options basics as well. I introduce you to the options world also in coming 2 weeks, so that you have some understanding of that. So if you have any questions related to futures trading, you can type your name. I'll come to you. You can ask the question. You can unmute yourself and ask the question. If you have any question, type in your name. I'll come to you. Yeah, Aditi, you can unmute and go